Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. Giving you sincere and actionable ideas is what we're all about. And first thing we got to address is, what does it mean to have a real retirement plan? What's an actual retirement plan? And maybe we start by even describing what a retirement plan is not. And I thought the best way we could do that is start to banter and role play it out. I'm being joined by David, one of our top wealth advisors. David, first, talk about what a retirement plan isn't, and then let's get into the processes that have been tested in the trenches at VestGen to get people not just to be retired, but to make sure they stay retired.
To me, a retirement plan is not a product. A retirement plan is not an annuity. It's not a mutual fund. It's not an ETF. Those are tools to get you from point A to point B. So I think that's the key, because from the last 10 to 15 years, we've heard that from a lot of folks, that they have a product that's going to make everything okay. But markets evolve, things change, tax rates change. And, I think the one thing that's important in retirement planning is you have to be willing to adapt as these things change. So it's a process. It's not a product you can buy, and it takes a while to get ramped up. But the key is, over time, you will make modifications because life is dynamic, and it's not something that you want to set it and forget it. It's something that you're going to want to readdress every 12 months.
So, David, when we talk about the elements that go into retirement planning, talk a little bit about how at VestGen Wealth Partners, we use a combination of goals-based planning in addition to cash flow planning to get people where they need to go.
Well, when I think of goals-based planning, that's our starting point for a lot of folks. And with that, we are looking at how much they're saving now and how much they will likely need in the future. And one of the reasons we do that is not everybody lives their life off an Excel spreadsheet or a Quicken worksheet. So we need to start with the basics. How much are you saving in 401ks? How much will you get from Social Security, pensions, etc.? What's our spending going to look like? And the way I think about it, that's kind of like stress testing. Do you have enough money, right? So a lot of times that's done via some type of fancy Monte Carlo analysis. But at the end of the day, all that's proving out is have we accumulated enough capital to last us through the next several decades of what I'll call permanent unemployment? That's step one. And I think
So David, if I pair that back to you, as we're talking about all things that are retirement planning today, the first step is to really make sure that we have a disciplined approach and process to determine if we've reached critical mass. Critical mass meaning we have enough resources, regardless of whether those resources are passive income properties, portfolio values, other forms of whatever it might be, retirement income sources. The first step is to determine whether or not we have critical mass. That's what goals-based planning is about. And David, before you talk about moving to the next evolution, cash flow-based planning, talk a little bit about, you mentioned the words Monte Carlo. What does that refer to, and what is the purpose in a goals-based retirement plan?
Monte Carlo to me means we're running perhaps 1,000 different trials of retirement, both with perhaps highly forecasted investment returns, low investment returns, and kind of anything in between that. And we're trying to take the average of all of those to figure out, like, how confident are we that if we live this long with this amount of capital saved, that we're going to be okay. So it's not assuming a specific rate of return happens every year. It's more real life. Sometimes we'll have really good returns. Sometimes we'll have bad returns. And also, what are our sequence of return? Sequence of return is a big deal. Sequence of return refers to the concept of, are you retiring into a market that is moving higher, or are you retiring into a bear market? In the first 2 years of retirement, you see negative returns. Everybody's seen those charts that those that start with a safe amount of money, it really depends on what those markets look like. And I generally think that if people can kind of protect the downside and be cautious of those first couple of years, then oftentimes the upside will take care of itself. But it's a way to kind of look at things in a more realistic front, as opposed to someone just saying you're going to make a certain rate of return on your money every year. That might be the long-term average, but we know that the market never makes 10%, let's say. Sometimes it makes 15, sometimes it makes 2, sometimes it loses 7, etc. The concept is let's use some averages and realize that things are going to be very dynamic.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and take advantage of developing what David just discussed, which is a goals-based retirement plan that stress tests changes in tax law, changes in inflation, rolling period investment returns, so you too can get a better bogey and a better benchmark as to whether or not you have yet to achieve critical mass, and then use that information to unlock, if you're not there, key steps to get there. So David, we just talked a little bit about the foundation of a goals-based retirement plan, how that's done through modeling and stress testing, as you said, but then how do we grow up? Or I believe you refer to it as leveling up. What's the level up, David, from a goals-based retirement plan that we deploy at VestGen Wealth Partners to help people not just get retired, but stay retired?
The leveling up is the liquidation order of accounts, the Roth conversion strategy, the withdrawal strategy, the arbitrage between a 12% tax rate and maybe a 32% tax rate for some folks. But Craig, I want to go back to this kind of phase one first, if you don't mind, which is there's a lot on the internet that we read about, like what's the best retirement calculator to use. And there's a lot of back and forth and banter on websites. And one of the things I would say is it's the assumptions that we're using that are critical. It's not the calculator itself. And I think that one of the things that we've learned over the last several years is you have to be willing to modify some of these expectations. A lot of calculators online might have the plan ending in the mid 80s, right? Because maybe that's the general mortality table that's provided, right, by the government. But I think investors have to ask themselves is that what it looks like with your family history, right? Like, don't we want to push that out a little bit more with healthcare, right? So we might need to adjust that in real life. Number two, some of these things just generically say you only need 75 to 80% of your pre-retirement income, right? I don't know if that's true. For some folks, they might need more than that, right? It depends on your situation. And then when you do inflation, right, it's very hard to project out 30 years of inflation, because in certain decades, we've had massive inflation, and in others, we've had quite low inflation. It depends on when you're actually retiring. So I think the point I want to drive home to everybody is you have to make these assumptions yours, and you're better off using more punitive data, higher tax rates, watered down returns. If things work out better, fantastic. But if you think about the way that we were running plans with the perhaps phasing out of the Tax Cut and Jobs Act and now kind of putting that back into play and all of these different things, like all of these plans need to be adjusted. It's not a set it and forget it scenario. I don't know if you have any commentary on that, Craig,
so
but
if
I think that's really important.
Yeah, so if we're listening, if you're just tuning in, we're talking about the hallmarks of a great retirement plan. And we've been talking about goals-based retirement plan, stress testing using Monte Carlo simulations. And David just said something brilliant that bears repeating in brevity form, which is don't get lured into false senses of security by having bad input. Bad input can be underestimating what you really need. Too many online calculators are going to do that. Bad input can be flawed inflation assumptions, flawed rate of return assumptions, just bad input in general. And the way you avoid bad input is through multiple scenario analysis. David used the word punitive. That doesn't mean your retirement has to be punitive, but it means if you want a sense of security and solvency and preparedness and flexibility, then do what a stress test is supposed to be. It's not designed to make things look good. It's designed to reveal blind spots, because when you solve for the blind spots, you end up future-proofing yourself. And if you want help, you can get it. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and take advantage of a complimentary analysis and visit with us today, where we can unpack some of these things that we bring to you every single week on this show, on this station, and all of our media, because we too want to make sure that you don't just survive in retirement. We want to make sure that you thrive in retirement, which means worry less in order to live more and pursue the fruits of everything you've ever worked towards. Hey, I tell you what, when we come back, we're going to bring in part number 2 of this, which is we're going to go more in depth about how we do this. And after we've graduated from a goals-based retirement plan to determine critical mass, what does it mean to engineer that liquidation order, that cash flow plan, and what are some tips of the trade that you can use to start getting further empowered? You're listening to Craig and David in the Know Radio on your favorite station, AM 560. We call it The Answer.
You want more in the Know Radio? You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
All right, I'm excited. You're excited. Everyone should be excited. In our last segment, in case you missed it, we've been talking about what it means to have a retirement plan. And part 1 is all about critical mass, goals-based retirement planning, overlaid with stress tests that comes from sampling, Monte Carlo, and making sure that it's intellectually honest with the input, because you can't afford to simply rely on online calculators, and you can't afford to work with advisors that are doing boilerplate planning. Once we get through that process of determining critical mass, now it's all about customization. David, walk us through the phases of customization that occur through VestGen Wealth Partners when it comes to developing the next stage of retirement, which is cash flow planning.
Lots of times when I think of cash flow planning, I think of liquidation order. So maybe the best thing for us to do is to use a real life example. So I'll give you a real life example, Craig, of a couple that I work with that happened to be the same age, and they retired when they were 62 years old. So they retire at 62, and the first hurdle that we know that we needed to address together was, how are they going to get health insurance? Because neither of them had corporate retirement health insurance. So for them, the most logical place was they went on to the ACA. So now they're on the ACA, and they know that the ACA can be a little bit difficult to navigate because the premiums are based off your income. Now, this family had something going for them, and I'm going to call that tax diversification. And what I mean by that is they did a good job saving in their 401k plans, but they also did a good job building up their non-IRA, non-401k savings, like their trust money. And so in that case, the strategy was, look, we're not going to touch the 401ks, the IRAs, or their smaller Roth IRAs. We're going to live off of the trust money. And the reason for that was while they were both employed, they were in a 32% marginal tax rate. But now they control their income. So starting the year, the only thing they're reporting on their tax return is interest, dividends, and any capital gains. And we wanted to achieve two things. The first is we wanted them to qualify for subsidies on their healthcare. So we had to keep their income very reasonable. And number two is what I call kind of taking advantage of that, what I'll call tax arbitrage right away, which was they wanted to get some of the money out of their 401ks at a much lower rate. So meaning they were getting a 32% deduction as they put money in. Now they wanted to get it out at, say, a 12% marginal rate. So that accomplished two goals for us. Number one, above and beyond interest, dividends, and capital gains, we're able to control how much their income is. So even though they might be worth a lot of money on paper, we're only showing that their annual income was around, $90,000 as an example. What that did for them was qualified for subsidized healthcare. And number two, we were doing conversions. So they weren't actually living off of the IRA distributions. They were living off cash that we had set aside. But the income that was coming through was through conversions. And so our game plan was basically, we're going to do conversions the first 3 years of retirement, 62 to 65. And that idea is let's try to transfer as much money as we can into that tax-free safety zone as possible, because you haven't been in a 12% tax bracket since you were 18 years old. So we got to move and strike while the iron's hot. And if we think about that, with the big, beautiful bill, right? Tax rates have been extended. This gives a lot of families more opportunity to use a similar strategy. So when we think liquidation order, it's because everything is related in retirement. Their health insurance is related to their investment income, which means we have to be very explicit as to where we select our distributions from, how much taxable interest we're going to have. But if you're forward thinking enough, the key is they put themselves in that position. Because our game plan several years of retirement was, let's build up as much of this non-qualified money to bridge the gap into Medicare. Once they're on Medicare, we don't have to worry about as much of the income thresholds, because it's kind of standardized pricing up until our income gets a little bit higher. So I think if we take a step back, what I would say is the most important thing that family did was to plan out their cash flow, not the year before they retired, but plan it out several years before they retired. And in all transparency, I'll be honest, I think at the time we were starting to put some of that stuff together, they're like, it seems a little bit premature that we were hoarding some cash and stuff like that. But I think now that we've gone through the process, they've seen the benefits of perhaps being in these lower marginal tax rates, doing these large conversions to transfer money to Roth IRAs. They can look forward now and say, oh my gosh, we're going to end up transferring money to our children tax-free through these Roth IRAs. Like, this is a great deal. So the way I like to view this is we like to build this out in phases. What's phase one of retirement going to look like? What income sources are you going to utilize? What particular accounts? Then we have phase two. Phase two is something might change. A lot of cases, it could be bridging into Medicare, or in certain cases, it could be one person in the family wants to turn on their Social Security. Phase three, the next person turns on their Social Security. And so what I found is, and we know this is how the world works, some people are very visual learners. Some people love big pie charts. Other people like 2-page plans. And I think the key is there's no one size fits all. For most of the families we work with, we try to create multiple versions of the exact same thing, because people grasp onto the ideas in different ways. But I think, as you outlined, Craig, the key is there's not a one-stop shop or one approach that is best. You probably want to be doing all of these different approaches, which is, let's do the high-level goals-based planning, stress test it out. Do we have enough money? Then let's build out the cash flow, because the cash flow is a great reminder that people can look at over a cup of coffee on a Saturday morning with their spouse and just say, oh yeah, I know, at my birthday, we're going to make a change, right? And that change is we're going to change where we're getting the money from. And what's the reason? Well, it's all in writing. And I think that's the key with financial planning today, right? Like, how many people out there actually have a tangible retirement plan that they can pick up and they can feel and they can review, right? That is the key. Everything else is portfolio management, and that is extremely important. But if you don't have that financial plan, sometimes it becomes more difficult to make those portfolio decisions. We talk a lot about, how people should adapt and adjust and create better risk-adjusted returns on this show. Some of the ways we figured that out is we stress tested against their financial plan. So, Craig, I'll throw it back into your court. How do you make those decisions with clients as to whether they should adjust some of their investments? Certainly, people have a gut feeling, but other times you have to stress test it with data to say, hey, should we do this? And what is the long-term effects of us adding more risk or de-risking? We want to make sure that we're utilizing technology to do so, right?
Well, let's dovetail into using the planning process to adapt to invest better. But if you're just tuning in, we talked in our first segment today about goals-based retirement planning and critical mass. We just went into a thorough discussion where David, one of our lead wealth advisors, went ahead and showcased how you too can be of higher net worth. But as long as you get in front with plenty of time, you can strategize. David talked about a very successful family who bridged the gap to Medicare prior to being 65, leveraging premium tax credit subsidies. David mentioned the conversions. Those are Roth conversions. David mentioned the concept of non-qualified. That means your non-retirement accounts because you need to be tax diversified. All of this is grounded and rooted in strategy that is unique as your individual family. If you want to take advantage of these forward-thinking ideas because you too want to thrive in retirement, we're a phone call away. 833-964-PLAN. That's 833-964-PLAN, or go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. So David, you had pivoted and tossed it back to me and said, how does the financial planning discipline of goals-based planning and cash flow-based planning allow us to be a better investor? It's simple. It starts with understanding someone's risk budget. Your risk tolerance is how you feel. That's sentiment. That's emotion. Your risk budget is your actual capacity to absorb risk at different phases in your life. And a big part of the retirement planning process, both goals-based and cash flow-based, is coming up with your risk budget score. Because if you don't have a scorecard, how do you know that you're properly invested? I mean, this industry idea that people should be 60-40 or 40-60 or 50-50, I'm talking about different ratios of stocks to bonds. That's not bespoke. That's not custom. The only way for you to figure out where you can be so that you can make modifications to where you want to be is to know your risk budget, and that should be quantified and helped through a good financial advisor. We at VestGen Wealth Partners help you do not just that, but all of those things. That's what it means to work with a family office. It's a one-stop shop for your taxes, your estate, your retiree healthcare, your cash flow modeling, your goals-based planning, and of course, your investments. More on that investment piece and risk budgeting when we come back. You're listening to In the Know Radio with VestGen Wealth Partners, Craig and David, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
All right, you heard it from David. He just teed it up. You need to make sure you understand your capacity for risk. That's all about the concept of a risk budget. Very different than risk tolerance. Risk tolerance, what are you going to do? Invest based off of answering 10 to 12 questions, completing a risk tolerance questionnaire? Who does that? No, you know who does that? The bank will do that for you. The big brokerage house will do that for you. That's not the way to make a decision. Decisions are a data-driven process because data-driven processes are systematic and repeatable, which makes them much more reliable, which makes them tested in the trenches with us. So what we will do is we will put together your goals-based plan with your cash flow model and then input the total sum of all of these investments you have to determine how different accounts should be invested based on when those accounts are going to be consumed, how those accounts are going to be taxed, and ultimately how those accounts are going to be inherited to lead us to one guiding investment policy. And the best part is technology is fantastic. Those who adopt technology, those who embrace technology, those who invest in technology always are a leg up. And we are a huge deployer of technology at VestGen Wealth Partners. And I encourage you, if you want to find out how various trade circumstances are going to affect your portfolio, we can stress test for that. You want to know exactly how Jerome Powell's interest rate decision in September, October, and December will affect you? We can stress test that. You want to know exactly what it means if the US dollar softens against the euro by 10 to 11%, like it already has year to date? We can stress test that. You want to stress test or role play all these different things? That is what we do, and we do them very well, because how else do you come up with a risk budget unless you're actually quantifying the risk with data? David, what else would you add relative to risk budgeting and the type of stress testing we do leading to better investment results?
It reminds me of a conversation I had with a client a couple of years ago. And as we were kind of finishing up the meeting, going through the cash flow plan, he had said something like, so what's my overall allocation between stocks and bonds? He's like, it looks like it's going to be like 65-35, like kind of like a balanced portfolio, or 70-30. And I said, yeah. And he said, is that based off your macro view of the world and current taxes and politics and all that? I said, absolutely not. It's based off the amount of money that you need to withdraw from your portfolio over the first 6 years of your retirement. Meaning we had reverse engineered how he was going to withdraw the money so that at the end of the 6 years, his allocation was going to actually change. But what he wanted was what I call permanence and definition in the portfolio. So he wanted a way to essentially stagger out safe money investments, investment grade corporate bonds, so that every couple of months he had money coming due in his account. That would take him till 70. And at 70, he and his spouse would max out their Social Security, live off their pensions, and really not have to touch any of their investment capital. So over time, there was going to be a natural rebalancing in their accounts. And I think that caught him off guard. And I would say he was pleased with that, because he was like, oh, so it's not just like some guess as to what's going to happen in the market. No, it's 100% based off the amount of capital that we know will be withdrawn from your portfolio. That's how we build this stuff, not based off of 80-20, 70-30, 60-40, et cetera. The key, I would go back to this, what I said before, is if you protect the first several years, that kind of retirement red zone, then I think that gives you the ability to always reapproach your asset allocation down the road. But if you get blown up and you retire in 2007 and 2008's a bear market, you've got a serious problem on your hand. And Craig, I think you would speak from your experience too. We have lots of clients that are in their 80s that invest more aggressively than those in their 60s even.
Because they've earned the right to do so when they got there. Your 80-year-old self needs to invest differently than your 60-year-old self. And this conventional wisdom that you should be more conservative as you age, I understand why it resonates with people, but is it necessarily right? Listen, what if you're 80 years old and you've got a massive portfolio of treasury bonds, municipal bonds, and CDs that's going to cover you? You know where all the other money can be invested? It can all be invested for generational wealth and generational growth. And why shouldn't it? So, David, you're right. It's not uncommon that if we have an 86-year-old client and we also work with their 60-year-old son, that 86-year-old client could have a more assertive investment posture than the 60-year-old because they've earned the right to get there. Right? That's really what matters. David, this sequence of return risk is so incredibly important. I want to address with everybody why they can't take blended withdrawal strategy. I want to address with everybody why the money can be in the 401k plan and the target date fund while you're growing your capital, but why it absolutely can't be there while you're spending and using your capital. But first, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download our free publications like OBA, the One Big Beautiful Axe, Tax Opportunities for Investors. That's information that you need. Now, David, why is it that sequence of return risk? You mentioned it twice today. I'm going to tee it up for you a third time. Why is that such a big deal? And why are target date funds, blended withdrawal strategies, and advisors who just push a button to send out people's money, why are they doing everybody in America a disservice when it comes to the concept of staying retired?
Well, sequence of withdrawal risk refers to, like, the risk is if you retire into a bad market. So you retire and maybe the next 12 to 24 months, markets are declining at the same time that you're taking withdrawals. And even though the market will likely go back up, you've depleted your capital base. So you're probably not going to get back to par anytime soon, if ever. That's much different than investing and having double-digit returns for the stock market early on. So when we say you got to protect those early years, we're trying to protect against those big risk-off events that can happen in the stock market. To your point, in terms of the withdrawal strategies, a lot of withdrawal strategies, either 401k plans and oftentimes in advisor portfolios, are what we call pro rata. So as money is coming out, what's happening behind the scenes is often there's an algorithm that's just selling all of the investments at one time. And even if we use this year as an example, if we go back to the sell-off that we had, peak to trough, we were down almost 20%. You probably didn't want to sell some of those tech stocks when they were down 25, 35%, because now they're doing dramatically better. Wouldn't you like to cherry pick the assets that you sell in March or April so that you're selling things that have actually done well? That is the concept. So flexibility and customization is key. But in any given year, you're going to have stock prices, bond prices all across the board. And I think all I would drive home for everybody is you deserve to do things at a higher level. You deserve to be able to cherry pick where money comes from the portfolio. And a lot of times that's not what's happening behind the scenes. There is a better way out there. That's what we do here at VestGen. We build customized portfolios that give you the luxury of choice from a tax standpoint, from an investment standpoint, and from a liquidity standpoint. And liquidity is huge in those first several years of retirement. But the good sign of an advisor is one that's always thinking several steps ahead. And so if we plan that out early enough, you'll understand your liquidity, your taxes, and then your flexibility to sell whatever investments you need if you need cash flow.
Don't be complacent. Complacency is the enemy of you staying retired. Don't allow yourself to simply do pro rata withdrawals, as David said. Make sure you work with advisors that aren't just hitting every dollar, where 60% comes out of stock, 40% in bonds. That means with market volatility, you're giving money away in your target date fund, your prefabricated asset allocation model. That flies in the face of buy low and sell high. Don't let that be you. Let us at VestGen Wealth Partners guide you to a higher elevated level of care. More on why we're equipped to do such right after this break.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
I got to tell you, we've covered a lot of ground on a Sunday morning. I'm just excited for that Bears game that's happening tomorrow night against the Vikings. Yep, that's right. I predict we are going to be 1-0 by the time it is over. All right, now, we talked about goals-based planning. We talked about cash flow modeling. We talked about the concept of risk budget and sequence of returns. But capacity, just as risk budget demonstrates your capacity to invest, your capacity to absorb risk, capacity is also a very important consideration when you are partnering with a wealth manager to help you be a steward of your finances. And you know what? Capacity is not given to everybody. Capacity is not present in every firm. Capacity is scarce in the business of financial advice. David, talk about why we have been so thoughtful and so intentional on building out capacity inside of VestGen to give people that higher level of care that comes from multidisciplinary professionals inside of a family office.
Well, as we always say, good advisors are always thinking 2 steps ahead. And kudos to the leaders of VestGen, you included, Craig, thinking 2 steps ahead from a business standpoint to always make sure that we have those team members before we actually need them, right? So hiring well in advance of the need. But I think, as everybody knows, things are just so dynamic. And if I'm in the conference room, and someone else on our team is on the phone, who's running the money, right? So there has to be people in the background that sit in front of their desks between 8:30 a.m. Central and 3 o'clock Central that don't leave, that can execute. Because as we know, markets move very quickly today. And there's a difference between maybe selling at the bottom and selling at the top of the market in any given day.
That's right. This is an execution business. Let me say that again. We're talking about the business of financial advice right now. This is a implementation quotient. It's always been about IQ, intelligent quotient, but a big part of capacity, and that's why I'm highlighting VestGen Wealth Partners, is about the implementation quotient, the capacity. David, I have long said, for as long as we have been in business, that it can never be about me. It can never be about you. It can never be about a solo advisor, because to everyone who's listening there right now on AM radio, if you're working with a solo advisor, or a solo advisor who has an assistant, or a solo advisor has 2 assistants, when your advisor is meeting with you, who's watching your money? When your advisor is working with other clients they serve, who's working on the money? The bottom line is, at VestGen Wealth Partners, we have people who are dedicated and in silos to do the trading, people who do the rebalancing, people who do the goals-based planning, people who do the cash flow modeling, people who do the retiree healthcare, people who do the long-term care, people who do all these different things, which allows us to create a much more responsive, much more intimate experience with our clients, because we're not required to be all things to all people. We have multiple professionals so that we can handle all this. But David, that just doesn't exist in the real world of financial advice, does it?
No, I don't think it does. And, everyone's about margins, and certainly that's important if you run a business. But as a consumer, you have a choice. You have a choice of how you invest, who you work with. And I think in this environment, you probably are going to want to hire a team of individuals to help act as a steward of capital, as opposed to 1 or 2 people. Because the reality is how many families can 1 or 2 people actually serve? Probably not that many. That is why a team approach is required, and a team that has significant investments in technology to keep track of everything moving forward. I always laugh when people say they have customized portfolios. How many customized portfolios can you run if you're managing several hundred households? I'm guessing no one's paying attention to some of those.
And you know what? That's a great segue into our next comment, which is the rebalancing process. Here's what's dead, America. If you're rebalancing your portfolios on a quarterly basis or rebalancing once a year on an annual basis, why in the world would anybody rebalance based on a calendar? I mean, I guess it's better than nothing, but oh, wait, that's what's happening out there in the world of financial advice. Why? Because solo practitioner advisors don't have the capacity and bandwidth, so they rebalance portfolios when it's convenient versus rebalancing portfolios when it's dynamic to do so. David, what does that mean for us at VestGen Wealth Partners versus other people in the industry?
Well, for everything, there's a target, right? We would be willing to do this at this specific price. And when we get to that price, it doesn't matter if it's March 31st, June 30th, or the 4th of September, right? That's the key. It's just like going to the grocery store or buying a new car. You'd be willing to buy a specific item if it was at a specific price. That's the way investing should work. You want to buy at low prices and ideally sell at high prices. It's harder to do that, in real life than to just say it. But I think the key is if you don't have that whiteboard and you don't have that process systematized, you're going to have some issues. And look at how quickly these V-shaped recoveries happen. Craig, you probably saw that article from Tom Lee the other day. Everyone's saying like, oh, this is unfathomable. How could the market come back up? V-shaped recoveries are actually much more or happen with much more frequency than people realize. The U's don't actually happen that much. And if you're going to have V-shaped recoveries and you have price targets that you would be willing to buy, that means you might only have several days or a week to execute. You can't wait till the close of the quarter. And that was just proven by what we experienced in March and April of this year.
Absolutely, 100%. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. And when you're there, download one of our free publications like the One Big Beautiful Bill Act, Tax Opportunities for Investors. You can harness some of what you hear on the radio with things that you can read so that we can have better conversations together to seek improvement because, again, you deserve to thrive, not just survive in retirement. David, as we're talking about portfolio rebalancing and not doing it on a calendar basis, but doing it dynamically, pairing that portfolio rebalancing concept with price, because price always matters, in line with people's tax budget, just as they have a risk budget. Give an example of some of the things we did, not too specific, but generally speaking, in portfolios in March and April of this year, because boy, it was easy to sell some of that quality trade into strength to buy other stuff into weakness.
I'll give you two examples. So once it became evident they were going to push through with the tariffs in March, that was another opportunity for us to add more to precious metals. I think that's one thing that's been very important, and we've seen tremendous demand for those precious metals. Number two was in April, not all stocks were falling. That's the key. We always think of it as a stock market, but this is a market of stocks. So while you had some high-flying tech names trending downwards very quickly, you also had some high-quality dividend stocks that were moving higher. That was a great opportunity to rebalance out of some of those higher quality names and pick up some stocks that may have just seemed too expensive. That's some of the things that we do. We're not timing the market, but the reality is we had the price targets already on paper before all that happened. I think we were surprised that we got there so quickly, and then you execute and then you're happy after the fact. That's the key, is have it on the whiteboard, have it on your computer, make it systematized, and you'll be in good shape.
And make sure you work with advisors who have the capacity to pull it off. Did your advisor take advantage of the downturn in March and April, or was your advisor too busy being on the phone and there wasn't somebody in that advisor's office able to do the execution. That's part of the VestGen difference. That's why it takes a team approach to the stewardship and management of money. So you too don't just get retired, but you stay retired. Hence the tagline. Check us out online at getretiredstayretired.com. That's getretiredstayretired.com. You're listening to Craig and David in the know with VestGen Wealth Partners on AM 560, The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Listen, I got to tell you, I love this radio station. I love what it stands for. You do too. And if you want to start working with like-minded advisors, like-minded people, give me a call, 833-964-PLAN, 833-964-PLAN. Check us out online, getretiredstayretired.com. You've heard all of my euphemisms, all of my acronyms for the past 14 years on radio. And here, think about the themes of this year: pragmatic optimism. Making sure part of that implementation theme was diversifying your diversifiers. David highlighted the need for precious metals and other components. And now I reveal to you what you need to be thinking about for future proofing. And it's really this: it's real return investing, Because if you say, what is the enemy of all things retirement? It is inflation. Inflation remains the silent killer. But inflation comes in many forms. There's the obvious inflation, consumer price inflation, what we see that we're paying for. There's things that lead to consumer price increases, like producer price increases, the inflation on the people who make and render the goods and services. But you also have to think outside the box, everybody. You got to be thinking about currency issues. Yes, currency. If you're listening right now, I know this. You live in America. You're a patriot. You have U.S. dollars. But if your U.S. dollar declines in value, the likes of which you've already seen this year, down 11% against Forex, a basket of currency, you now know that your dollar is going to buy less goods and services. Well, if your dollar is going to buy less goods and services, that's an example of inflation. And if we've entered a new and different world order where all these other countries respect the United States, oh, yes, they do. All these other countries will continue to use the U.S. dollar as their world's reserve currency, but all these other countries choose not to be as dollar denominated as they once were. Well, then that means the dollar might continue to give back its gains, the gains it's made over the last decade. So what do we need to do for this next decade into retirement to protect our purchasing power? That's what real return investing is all about. That's what I invite you to learn more about too, so you too can get retired and stay retired. 833-964-PLAN, 833-964-PLAN. Connect with us online. GetRetiredStayRetired.com. GetRetiredStayRetired.com. Hey, it's Sunday. The Bears play on Monday. Go Bears!